G'day Brenda, thanks for the comment. So I was told that I should transfer my property into a trust when I die instead of bequeathing this to my sons, and it means no capital gains tax. So this may be referring to what's called a testamentary trust or a testamentary discretionary trust. It's a little known strategy that is a phenomenal estate planning tool. I'm running through some of the considerations and why you might want to consider having a testamentary trust as part of your estate planning. So let's get stuck into it. So estate planning is a bit of an icky subject. Most people don't like to talk about death, to consider their impending demise, right? But it's a fact of life, right? It's important that we have the right estate plan in place, particularly when we've got kids, we've got future generations that we need to consider. Not having at least a will can leave your family members in a really precarious situation of passing away intestate. I can do a separate video on that if anyone is interested. But above and beyond a will is a clause in that will that's called a testamentary trust. It is a death trust. It's basically a trust that only gets established in the event of your passing. And the reason why we would consider having a testamentary trust is that in your will alone, if you bequeath your estate to a particular individual, that can lead to a couple of situations. One, there is no capital gains tax on transfer on death anyway. However, what it does provide access to is the ability to protect those assets and to provide tax optimization opportunities. Let me flip the camera around and give you a little bit of a rundown. Okay, so we've got a little bit of a diagram here, and this basically outlines the key parts of an estate plan with a testamentary trust. So your will is a transactional document. In the event that something happens to you, your executor will find your assets, they will settle any liabilities, and they will be left with a net estate. And that net estate will be distributed as per your wishes, assuming that it is not contested. Now, if you have a testamentary trust clause as part of your will, that testamentary trust has the ability to be established. And what that basically will do is that the assets that you've left to particular beneficiaries will go into that testamentary trust, and that testamentary trust can run for up to 80 years. Now, the benefits of a testamentary trust is that it can only benefit the beneficiaries and their lineal descendants, which provides a couple of opportunities in the future. So let's say, for example, these beneficiaries here are married and they subsequently divorce. Any of the assets that you have held in this testamentary trust are not going to be clawed into that particular situation. And they can pass that on to their children and their children's children for up to 80 years. The other added benefit is that particularly if you have children that are under the age of 18, if they are beneficiaries of a testamentary trust, they are taxed as adults instead of being taxed as minors. And minors are taxed ridiculously in this country. Let me show you. If you are under the age of 18, you can receive up to $416 a year in tax, in income, and pay no tax. Anything between that and $1,300 is 66 cents in the dollar. And then anything over $1,300, you pay 45 cents in the dollar tax, which is not nice. Compared to normal individuals, adults who have the ability to claim the tax-free threshold, essentially meaning they can receive about 45 grand a year tax-free. So that's pretty cool. Now, being mindful that what typically happens in most situations of a will is that the assets, particularly if it's property, are encumbered, meaning that they have a liability. So the biggest issue that we often see is, irrespective of whether there's a testamentary trust or not, do beneficiaries have the capacity to take on the debt associated with those assets? Because they can't just take over the loans. Typically, they'll need to get their own loans if they want to buy or keep those assets, right? And secondly, do they want to keep those assets? And that forms an issue which can sometimes result in a future tax liability that needs to be considered. Now, passing those assets to them does not result in a capital gains tax event typically. For most people, in the vast majority of circumstances, whether it's a will or whether it is a testamentary trust. However, when they sell those properties in the future or sell any of those assets, there is quite a complicated workflow for you to be able to navigate depending on whether that asset will be CGT free or whether there will be a certain cost base that needs to be considered and they will have to pay tax on the difference. You need to get specialist advice on this from an accountant and a financial advisor to ensure that you can navigate that situation appropriately. There's certain timing around certain assets as well that need to be considered in order to ensure that there's no tax payable. So I hope this gives you a little bit of a crash course on testamentary trusts, some key considerations around capital gains tax. Make sure you get advice. This is just informational to give you some insight around these things, and hopefully this has been valuable. Catch you soon.